Hi, this is Jim Cunningham. Today, we're going to talk about inheritance strategies for your wealthy children. You know, sometimes the kids are wealthy, and a lot of people don't really think about things that you might need to do for that wealthier child to preserve overall family wealth, family multi-generational wealth. So, what happens when your child inherits money and your properties? Will they be hit with a hidden tax bill? And the short answer is yes, there is a hidden tax bill that lawyers tend to be familiar with, at least who practice in this space, and normal people not so familiar with. Are you kind of heaping it on the pile only to result in more taxes when your child passes away? So what we're talking about here is there's you and your wealth, and the example we're using is the child, but really it could be anybody you're leaving wealth to that already has significant wealth. That kind of gets heaped on the pile, right? And so not only might it be taxable in your estate, and it might not be taxable, but then it's also taxable again when that other person passes away. So what we're doing is we're looking at generation down. We're going to cover some of the strategies to consider when your child is wealthy. Now, if you happen to be the wealthy child and you're watching this because, like, I don't know if I really want this from my parents, but then again, there's this kindergarten fairness. There are all these issues that go with it, emotional issues. It's really something to pay attention to, because you may then go to your parents and say, hey, mom and dad, I saw Jim talk about this, and this is something you might want to consider. Many of these strategies, the reason is many of these strategies have to be set up by the parent. And once the parents pass away, it's too late, and the child really cannot set these strategies up. We do have an upcoming workshop in the Bay Area in the Berkeley Marina, and we're going to cover a whole lot, kind of like a almost like a Reader's Digest of all of the topics we cover. And it's going to be savvy tax strategies for high net worth families. So if you're a high net worth individual or, have a high net worth family, this is a great opportunity. I will be speaking in person, and this will be June 10th at 10 a.m. in the Berkeley Marina. So there's a QR code there if you'd like to reserve for it. We're going to cover capital gains taxes, keeping your Prop 13 tax base, very, very important, and methods of holding real estate, as well as income tax reduction strategies for business owners. We'll also cover IRAs. So very important, informative workshop. And you can meet me and the rest of the crew in person. I'm Jim Cunningham. I'm your speaker. I have over 25 years experience as a lawyer. I'm a certified specialist in estate planning, trust, and probate law. I'm also a pilot and real estate broker and securities and insurance license. So I'm a second generation lawyer and a third generation pilot, also a real estate investor as well. So kind of a broad background. These are the lawyers in our firm. We've got a great team of lawyers, and we're really focused on helping, regular people and higher net worth people, but people with their estate plans and estate planning issues. And, lately Prop 13 has been a really big issue for a lot of families, whether you're wealthy or not. And that's something that we are really focused on as well. Go ahead and subscribe to our YouTube channel. If you don't subscribe, you won't see the little bell. There's a little bell that alerts you as well. And then this will pop up in your feed, and you can go ahead and see these videos as they come out, typically every Thursday at 6. Disclaimer, I'm a lawyer. I'm talking, words are coming out of my mouth. This is not legal advice. And I really mean this, because we're going to talk about some very complex concepts. And it's a little bit like, I hate to say it's a little bit like a pharmaceutical commercial. You kind of look at that and you go, well, is that for me? Well, you really do need to talk to a doctor. Same thing here. This is not the purview of self-diagnosis and do it yourself. So not a DIY project. So there are three big questions, I think, really before we get started. If you have a wealthier child, these are kind of three big questions that I know I ask of the clients when they come in. And really, I think it's appropriate to ask yourself, are they truly wealthy? And I think we have to ask ourselves, what is wealthy? Means different things to different people. It depends on age. It depends on where you live. It depends on income. It depends on assets. And sometimes people think their kids are wealthy because they're living that lifestyle. But I will tell you, many times the people who are the wealthiest do not appear to be wealthy. They do not drive the nice cars necessarily. I mean, they might. They don't necessarily live this wealthy lifestyle. The people who do live that lifestyle doesn't necessarily mean they're wealthy. But, if you have a child, if you kind of know that your child maybe started a company or worked at a company, especially in the Bay Area and the Los Angeles area, we get a lot of people that might be in entertainment, might be, at a tech firm, and have a big liquidity event when they're young. And they just have a lot of, they happen to be wealthy. You may also be a wealthy person, and your child may be wealthy by virtue of inheriting from their grandparents, or you might be a wealthier family and they're wealthy through gifts. So however it's made, we kind of need to assess what is wealthy, and are these children in fact wealthy? And this is really kind of the first question. The next question is, do you leave it outright, or do you want to protect it? So wherever it goes, and I would say this is kind of a more broadly general question about estate planning. When you leave this earth, your stuff stays here behind you. It doesn't go with you. And I mean, at least that's what's happened in all of human endeavors, right? A human passes away and their stuff stays behind. Somebody's going to own that. You don't want it to be the government, and that's like the last person in line who owns it. It's either going to be the people you designate, right, in your estate plan, or the people who are related to you in certain ways that California says, oh, if you have no plan, then these people get these assets. So do you want to create this? Do you want to have a structure where it's protected from threats or not? And really, that's a threshold question. And if it's protected, what type of protection is best? What type of plan is best? We're going to really be focusing on this number 3 here, which type of plan is best. The other one really is, does it make sense to give it to your wealthy child, or maybe give it to your child's children, right? That's an option. Or maybe some to your wealthy child, some to your wealthy child's children. We'll see there's a way where you can kind of have it both ways. Or do you leave it to the other siblings, right? So maybe your wealthy child doesn't have children, maybe won't have children, or even has children. Do you want to leave that to other siblings? I'm not encouraging anyone to do this or not do it, but it's something to think about. And there's a lot of feeling behind it. Obviously this is a very personal decision. So I would say there's an importance of mindset and really taking it to the next level. I would say too often when people come in to do estate planning in our firm, they're focused on what happens when they die. So when I die, this person gets whatever it is. Well, the people you leave that to, one day they're going to die too, right? They're going to leave this earth. I mean, it could be decades from now, but they certainly will leave this earth. And I think attorneys can be a little myopic. They can be short-sighted. They can say, well, let's avoid probate. I mean, that's kind of Captain Obvious stuff. Staying out of probates, we're not doing our jobs as estate planning attorneys, quite frankly, if our clients end up in probate, or we're doing a bad job. And that's kind of an obvious goal. But really, I think the lawyers sometimes don't ask questions about the kids. How are your children? Do they have, are there health issues? Are they wealthy, right? And many times we'll ask clients who come in, do you anticipate inheriting from a parent or some other person? So this is a very common question. And where do they live? Where you live is very important, because if you live in a state that has a state death tax like Oregon or Washington, Oregon's is 16%, Washington is 20%. When you leave money to a person in that state, those death taxes kick in well below the current federal threshold of $12,920,000. So we have to think about a lot of things as estate planning lawyers. I don't expect you, the client, to think about this, but this is something that if you're a lawyer watching this, you're gonna be like, yeah, Jim's right, because hopefully you're the kind of lawyer who would be asking these. And if they inherit, are they just throwing it on the pile? And this kind of goes back to the point I was making about, is it just going to be more to be taxed by the government? So let's talk about inheritances and estate taxes on the death of the inheritor. Now, what is the inheritor? The person who gets the inheritance. So somebody understand, if you're the person this obviously applies to you if you're watching this because you're living, estate taxes are going up, right? There's no way around it. There is law. So this law that was passed in 2017 during the Trump administration had a sunset provision because it did not get enough votes in the Senate to be permanent law. When certain bills do not get a certain amount of votes, it's called sunsetting, meaning it lasts for 10 years and then it goes away automatically. It would take an act of Congress, right? Both houses would have to pass the bill and the president would sign it in order to change this. So I don't see that happening anytime soon, right? So right now it's 40% on amounts over $12,920,000. In 2026, that not only is the tax rate going up to 45%. Now think about that. 45%, that's almost half of everything, really probably over about 7 million, because we had a 2011 under the Obama administration, we got a $5 million exemption in 2011 that is indexed for inflation. It was doubled in 2017, but that doubling that happened in 2017 is going away January 1, 2026. It's gone. So we're going back to our $5 million exemption or coupon. You can think about it as a coupon that is indexed to inflation. Other states, it's going to vary. I mentioned Oregon and Washington, and we'll be covering that a little bit on our June 10th in-person event in the Berkeley Marina. But the state death tax is very important because not everyone obviously lives in California. They live in other states. We don't want to overfill. So this kind of like overfilling. So if your child has a $7 million, and I'm kind of fast forwarding to 2026, if they already have a $7 million estate, anything you leave to that child without a certain structure, okay, because there is a solution to this, without a certain structure will be subject to at 45% plus death tax. Why do I say plus? Because you can have state death taxes as well as state inheritance taxes. So some people one state taxes you both ways, when you leave this earth or if you inherit something from somebody who has left this earth, they tax you both ways. So I do want to talk about compound interest because there's a time value to this. There's a value. This is the planning we're talking about is multi-generational planning. This is not planning for today. It's not planning for tomorrow. It's planning for a really long time from now. All right. This may be benefiting people that you will never meet. Maybe your great grandkids, potentially. You may never meet these people. Hopefully you will, but it's going to benefit people into the future. So if we look at an initial investment of $1 million in 10 years at a 7% rate of return, that money's going to be almost $2 million, right? So, I mean, 7% rate of return is pretty healthy, but 10 years, it's going to double. That's kind of the rule of 72. In 15 years, it's going to almost triple. And then in 70 years, I mean, it goes up 113x, 114x. This is $1 million kind of at 7%. And the reason we use 7 is this rule of 72, money at 7.2% rate of return doubles every 10 years. At 10% rate of return, it doubles every 7.2 years. But you can really see what we're talking about here with the planning, that this multi-generational planning. This is the time horizon. It's a 50, 60, 70-year time horizon. This can create tremendous wealth, can be a tremendous blessing for your descendants, so for your future loved ones. And here's an issue. Let's say you leave this money. You have a large estate, right? And this is kind of an outsized example, but in 2053, I'm kind of calculating based on inflation, the exemption will be 25 million if there's no change in the law. That's the exemption will be, I'm sorry, not 25 million. It'll be about 16 million. So amounts over 16 million would be taxed at 45%. That's about a $4 million tax bill. But if you leave assets to a child and those continue to grow, let's say that inheritance grows to 21 million, it's a $13.5 million tax bill. So it's either 4 million or 13.5 million. You're getting like a 77% reduction in overall death taxes by doing some planning now, really for your grandchildren. And this is what we're talking about. This is estate planning for your grandkids that may or may not be in existence. So what we're going to talk about is what is called a dynasty trust. Now, if you're a lawyer watching this, you go, oh yeah, that's the name that lawyers give a generation skipping trust. That's actually true. So there's a technical term that is a generation skipping trust. It is very confusing because that generation skipping trust addresses the generation skipping transfer tax system. But for clients and lay people, they look at that and they go, generation skipping trust, I don't want to skip my kids. I want my kid to get it. I just want it to be out of my kid's estate. That is a generation skipping trust, okay? That's why we call it a dynasty trust. So you'll see these are used for our purposes here interchangeably. So we'll talk about minimizing some strategies there. We'll also talk about IRAs. IRAs are well, we call those toxic assets potentially. So let's talk about the multi-generational mindset. So what is a multi-generational mindset? It is looking at what you have, your wealth, as a resource for the generations, not just yours. And you know what? If you are watching this and you go, it's mine, I really don't want to think about this stuff. Great. You probably stopped watching. But if you're the kind of person who says, look, I view that what I have taken a lifetime to save and accumulate, and maybe as a parent's lifetime as well, because you might have inherited significant wealth. If this is your mindset, if you see this as really a family resource, you really need to pay close attention. And I will say that you are teeing this up. If you live or your descendants live in coastal California, or really anywhere in California now, it is very hard to buy a home. I mean, this is it's not getting any easier. And many of our clients live in areas where the average home price is almost $2 million. How on earth, if your daughter wants to be a school teacher, how on earth is she going to be able to afford that? So this not only is it applicable to children who are wealthy, but also children who are not so wealthy, really as a family bank, for lack of a better term. So this is this locked treasure box. So it includes estate planning or viewing this in a multi-generational context, not just you, not just the kids. So again, it's no longer about just avoiding probate. That's basic, people. I mean, that's kind of presumed. That's estate planning 101. We're talking about creating a legacy that lasts for generations. Why plan? Why protect it? I'll tell you why you might want to think about protecting it. 70% of wealthy families lose their wealth by the second generation. 70%, it's gone in generation 2. 90% lose it by the third generation. Having and preserving family wealth are very different. So having it and preserving it. This requires careful planning, and people who care about preserving wealth for future generations do use a dynasty trust. It's very frequent. So the big threat we're talking about here, divorce is always a threat, even for a wealthy child, right? Divorce is a threat. Taxes, really, we're going to be focusing primarily on taxes, because what we're talking about here is if your child is wealthy and you kind of heap it on top, that's only compounding a tax problem. And, they're probably not going to fritter it away. We don't have these other threats. So really, we're going to be focusing on the tax threat and, frankly, the divorce threat. I do want to come back to this date, December 31, 2025. This is a date that we are really focused on in our firm, because this is the date, this is the last day that we're going to have a doubled death tax exemption. So this is the last date that you'll be able to transfer, which will probably be close to $14 million at the way inflation's going. That's going to be cut in half to $7 million. So everything over $7 million-ish, we're kind of guessing what that'll be, kind of projecting based on inflation numbers. Everything over $7 million, subject to a 45% death tax, due 9 months after death. There is a 5% per month failure to file and a 5% per month penalty for failure to pay. So those penalties go up to 50%. There was just a recent tax court case that came out that said people who receive property from an estate and the estate tax is still due, the IRS can go after the people who inherit the property, who receive the property. And I have not looked at the case yet, but I would suspect they can go after anyone for the entire amount of the deficiency. So this is really, really important. You have personal liability when you receive property that should have been taxed. There really is no way around this without planning. Okay, so then we're going to talk about the planning. So not only is the amount you can leave getting cut in half, but the taxes are going up more than 10%. So wrapping an inheritance in a dynasty trust is what we're talking about. So this is a trust, and we'll talk about what this trust looks like in a little bit. It's typically designed for wealthy people to, pass assets on to not so wealthy people. We're kind of flipping it on its head. We're talking about the parents creating a dynasty trust, many times within their living trust. And we'll have an example on this. So the parents within the living trust create a trust for the benefit of the wealthy child. The wealthy child has access to that trust. And when that wealthy child passes away, the assets in that dynasty trust pass to the grandkids without any death tax because of the child's death, because of the child's passing. So I'm going to say this another way, which is parents, if you have a wealthy child and you want to minimize the amount of death tax that the grandkids are going to pay, then you may need to do something now, right, to tee up a plan to enable your wealthy child to benefit from the property, and then have it go to the child's children free of tax. That is called an indirect skip. So if you're researching this, there's a direct skip, which is grandparent to grandchild. An indirect skip is money that goes, or assets that go in a trust to the child. And then when that child dies, they pass to the grandchildren. There are some limitations on that, and we'll talk about that. So if you're, right now you can put $12,920,000 into a dynasty trust. And if you have that wealth, great, but you may have a $3 million estate, and you may go to a lawyer and they say, well, you don't need a dynasty trust. You only have a $3 million estate. But if your kid has a $15 million estate, it would be nice to have that 3 million set aside. And that's what we're talking about here. So how did Dynasty Trust work? So a Dynasty Trust is kind of like a treasure box. You know, the analogy we use for a living trust is a bucket, right? It's a bucket with a handle. You put stuff in the bucket, and when you stop being trustee, that handle passes. This is a little bit different. So this is a treasure chest and it's locked and it has a lid on it. So you put assets into this, and many of our clients do this during lifetime. You can do it at death. So either way, but it has to be set up while you're alive. All right. This is not something that the child can set up. So these assets go into this box, and hopefully they grow. And hopefully those are kind of assets of a last resort for the wealthier child. So many times, you know, we will put assets that tend to appreciate in the Dynasty Trust. We're trying not to consume those assets. So you might have a family vacation home. Well, that might be a good Dynasty Trust asset. You wouldn't necessarily want to have an asset that's paying you an income. If you're a wealthy child, you would want to be burning your own assets that are included in your estate. So a little technical there, but and it's nuanced, and it's very obviously factually specific in whoever we're talking about in their individual circumstance. So it's important to understand that there's a box, right, which is the trust document. There's stuff in that box, in that treasure chest, which is the assets, and there's a key, okay? The trustee holds the key. The trustee is the one in charge. So the trustee is the one who controls the assets, and the trustee is the one who decides when and whether to make distributions. Sometimes it can be the trustee. It can be the beneficiary, the person who's inheriting, in this case, the child, the wealthy child. Sometimes not. Sometimes there are state income tax considerations. So there are a lot of different considerations, and that's really a one-on-one talk. But on a very high level, there's a trustee who's in charge of everything, who has access to those funds, right, to use them for the benefit of the beneficiary, the person who's inherited, in this case, the child. So once transferred into this trust, whether during lifetime or at death, it is in the trust, and it's not part of the beneficiary's estate. So in this case, the wealthy child, this is excluded from the child's estate. And that is why it sidesteps death tax, because it's excluded. What is a generation skipping transfer tax? This is very important. And this is the genesis of the term a generation skipping trust, because it deals with the generation skipping transfer tax. So before, I think it was 1987, there was no generation skipping tax, right? Then the government's like, wait a minute. If wealthy people skip their kids and it goes to the grandkids, they're saving on death tax, because when that kid dies, the government gets another bite at the apple. They get another, at that time, 55%, right? They get another 55%. So the generation skipping transfer tax is a tax that is imposed, and I'll walk you through how that's imposed on where if you skip a generation, if you give it to grandkids, or you give a gift to someone who's younger than 37 and a half years than you are. I don't know why it's 37 and a half. I don't know why they didn't pick 38 or 36, whatever. How do you calculate 37 and a half? Go figure. So if you try to leave money to a grandchild or someone at least 37 and a half years younger, right? Or they could be younger than that. They could be 40 years younger. The generation skipping transfer tax does apply. Now, under current law, the first $12,920,000 is a freebie. It's exempt. Amounts over that are subject to this tax. But understand that exemption used to be $1 million. And when I first became a lawyer, it was $1 million. And then it kind of got bumped up in 2011 under the Obama administration, when we got this $5 million death tax exemption indexed to inflation. So very important to understand this. So it's not an issue in 2023 if you have less than 12.92 million. But if grandma leaves 22.92 million to grandson, the first $12.92 million goes tax-free. The next 10 million is taxable twice. So what does that mean? So 10 million, you would pay 40% death tax on 10 million. So that's 4 million. And then on the remaining 6 million, you got to pay another 40%, which is 2.4 million. So that's $6.4 million, or 64% of the 10 million. That's why lawyers pay attention to this. That's why there are trusts for this, because you can have an inadvertent triggering of your generation skipping transfer tax if your estate plan is not drafted properly. This is very, very important. So if you're a lawyer watching this, unless you're very familiar with generation skipping trusts, I would bring in somebody, or refer the matter out, or bring in somebody who understands this, because this does not happen often because the exemptions are so high. It used to be a much bigger problem because people simply don't know, right? They just don't have a clue. I'm going to leave everything to my grandkids. Great. Well, if they went over that $1 million amount years and years and years ago, it was a problem. So after December 31, 2025, so January 1, 2026 going forward, that number is now goes to 6.975 million, almost 70% if that generation skipping transfer tax applies. So very important to pay attention to. Don't don't ignore that, especially as the numbers get high. And then the other thing is the law changes. You may have a trust and then the law changes out from under you, and now it's subject to generation skipping tax. So very important. So let's talk about Hal and Wanda and Sunny. So if you've seen these webinars, you hear a lot about Hal and Wanda. We got to, if there's a Hal and Wanda out there, please let me know. A real Hal and Wanda, I'm sure there is. So Hal and Wanda and their living trust. This is an indirect skip. So this is how you do it, right? This is the basics, the basic mechanics. So Hal and Wanda watch the webinar here, watch the video, and they go, oh yeah, Sunny, he's rich. He's started a tech firm and he's got, way more money than we thought we ever could. We're so proud of him. And this is just a wonderful thing. He's doing well. And they have a $3 million estate. Now, $3 million estate is not a small estate. It's not huge. And Hal and Wanda are kind of getting by, right? So we're in California. It's just kind of how it is. So it's $3 million estate. Hal and Wanda restate their living trust. What is a restatement? A restatement is when you amend your trust, you can change 1 or 2 pages, a provision here, a provision there. A restatement is a complete rewriting of your trust. Now, this is a little counterintuitive for clients. Many times it is more cost effective for the lawyer to rewrite the entire estate plan than it is to change this page, change that page, because fundamentally we're billing by the hour. Even if it's a flat fee, we kind of have to know what our time is, because that's how we measure things as lawyers, is how long does it take? And many times it's more efficient to do a restatement. So they restate their trust for a variety of reasons, because when you have a generation skipping trust in there, it gets kind of complicated. It's just too unworkable if you don't restate. So it is left to Sunny in a way where Sunny's the trustee, Sunny's in control. And this $3 million, Sunny, it's there if Sunny needs it, during his lifetime. And then when he dies, it passes to the children, to the grandchildren, to Sunny's children, free of any estate tax, free of any death tax. That 3 million very well might have grown to 20 million over a 30-year time period. That's not unreasonable if you don't touch it and it's invested well. And that saves $9 million for the grandkids. So fundamentally, what we're talking about here is Hal and Wanda are doing estate planning in their own estate plan so that their grandchildren pay less death tax. So the grandchildren pay less death tax. Okay, that's really what's going on. And it's protected from divorcing spouses, lawsuits, a whole litany of things. And again, this depends on who the trustee is. Typically, whatever you can get to, your creditors can get to. So you have to be, these trusts have to be artfully created. We use a trust protector, and we have some videos on that on our YouTube page. I would encourage you to take a look at that. But the trust protector is a good way of being able to modify, not change the trust, but take action with respect to the trust, because a trust protector has power over the trust, but is not the trustee. So that trust protector can do things to enhance the creditor protection of the estate. So what about a direct skip? Let's say they talk to Sunny and Sunny says, Mom, Dad, I just really, I have so much. I'd rather have this in a trust and have my kids benefit. And then, maybe you're teeing it up for the great grandkids, right? So maybe those kids will actually never need it because Sunny is going to provide for the kids. So we're kind of leapfrogging across generations. And so this money's excluded from Sunny's estate, well, because Sunny's not a beneficiary. And when Sunny's kids die, so the great grandkids, when they inherit, that trust has grown to 50 million. That passes free of death tax, free of estate tax. So that saves $22.5 million in tax at a 45% tax rate. And along the way, it's protected from inheritances or protected from divorces and lawsuits and irresponsible heirs. So that's an example of a direct skip, a little more powerful tool, right? That number's a little bit bigger on the death of the grandkids. And then there's really a hybrid. This is where Hal and Wanda do restate their trust. They do leave it all to Sunny. And then Sunny can decide after Mom and Dad die whether he wants to disclaim. Now, a disclaimer under California law, this is state specific. Sunny's a California resident. He disclaims under current California law. That is not treated as a gift from Sunny to his kids. Other states it is. So you really have to be mindful of this depending on state residency. But in California, Sunny could say, look, I don't want half of it, or I don't want any of it. But if he says, I don't want half of it, he still gets half, the kids get half, and then he can be trustee of that trust in this particular case. And that saves $9 million in taxes. So that's a little bit of a hybrid. So Sonny can decide. He could certainly disclaim it all, right? He could say, when mom and dad die, I don't want any of it, right? But that is using a disclaimer in planning. So yet another tool. IRAs, death, and the Beatles. What on earth am I talking about when I say IRAs, death, and the Beatles? Well, George Harrison got it right. We're going back to 1966, and he wrote the song The Taxman. And there's a line in it, 1 for you, 19 for me. I won't sing it. I can't sing. I wanted to sing. And Janine Cosden said no. I got a vocal lesson from her in Ojai in the late 70s, early 80s. She was just like, not going to work. So lyrics mocked Britain's high taxes. So what were the taxes? They were 98%, 1966. So they were 83% with a surtax of an extra 15. Not exactly a fair system, I guess. What about, and I'll let you know, the opening line is, let me tell you how it will be. Here's 1 for you, 19 for me. Keep that in your head, because the numbers actually kind of line up on the 1 for you, 19 for me. Because when you have an IRA, lawyers call these toxic assets in an estate. Here's the bottom line. Your IRA is potentially subject to 95.3% tax. What am I talking about? Okay. What I'm talking about, and I'm not, for the vast majority of people, I'm not talking about 2023, but 2026. So if you have assets greater than 7 million and you have an IRA that is not a Roth, right? So this is a normal taxable IRA. When that money comes out, maximum federal rate, 37%, state rate of 13.3%. You put those together, you do not get a state, you don't get a deduction for state income taxes paid anymore. IRAs are included in a decedent's gross estate. What does that mean? If you have $1 million IRA, it's subject to a 45% death tax. Your $1 million IRA is subject to a 45% death tax. When you take money out of the IRA, that beneficiary has to pay income tax on it. They tend not to take money out of the IRA until they have to, which is 10 years after death, and we'll talk about this. So what ends up happening is you have this asset that's taxable. You have to pay $450,000 in taxes on $1 million IRA if it's a taxable estate, and then you have to pay income tax when it comes out. So the money is taxed twice, and when you add up 45, 37, and 13.3, you get 95.3%. I had to triple check my numbers because I honestly couldn't believe it. So we're going to be doing a webinar pretty soon on this, on Secure Act 2.0. So there was a Secure Act which basically reworked the IRA rules. We cover this in my book, Savvy Estate Planning, 2nd edition. I would really encourage you to get this. But the rules are very complex, and it depends on who is the beneficiary, the status of the beneficiary, if they're minor, if they're disabled, if they're chronically ill, and it depends on whether or not you mess up the rules. And it also depends on the age of the person who passed away, whether they've started minimum distributions or not. So there's really no easy way to wade through this. Just know that they're complex. This really takes expert knowledge. And I would say lawyers as a class, very few, as a class of individuals, very few lawyers know enough about this. Financial advisors don't know enough about this. Okay. This is really the purview of really subspecialty within a subspecialty, which is us, right? You've come to the right place. So Hal and the IRA Legacy Trust. This is an indirect skip. So Hal names Wanda as beneficiary of his IRA. And if Wanda survives, she rolls that over, no problem. He's got a $3 million IRA. If Wanda doesn't survive Hal, so Hal is alive, Wanda passes away, and then Hal doesn't update his beneficiary designation, which he probably would do, but let's say he doesn't. The IRA goes to the Hal IRA Trust. So it's the Hal IRA Legacy Trust for the benefit of Sonny, his son. The $3 million is held in this IRA Legacy Trust, which is not his living trust. It is a specially designed trust. It's held in the trust after Hal's death. So Hal doesn't put this into the trust while he's alive. This is beneficiary designation driven, okay? And Hal can change a beneficiary at any time, provided he's competent and not dead. The IRA account and the IRA trust into which all the distributions are made is held for Sonny in a trust, and it's excluded from Sonny's estate. So what we're doing is we're saving the 45% death tax that would be levied when Sonny passes away. So in this case, there's no death tax, so we're only talking about income tax, and along the way, the asset's protected. It's also, if you name, for example, a Nevada trustee and have a Nevada trust, and Sonny's a California resident, if Sonny's not the trustee, you're deferring state income tax, not avoiding it, at least under current law. And you're also providing a management mechanism and keeping it out of the estate. So if you have an IRA, and a $3 million IRA is a pretty big IRA, does this work for a $100,000 IRA? Yeah, but this planning is not cheap, and it's pretty complex, and you have to pay attention to it as you age, because the math starts changing as people age, and it's something you need to pay attention to, but definitely worth it because you don't want to have this be taxed again. So let's talk about a charitable remainder unit trust in the context of IRA planning and Sonny. So this is getting it could get a little complex, but please bear with me, okay? What we're talking about is IRAs, retirement accounts, if you don't mess it up, okay? If you mess it up, everything has to come out in 5 years. If you don't mess it up, everything has to come out in 10 years. But with a charitable trust, you can spread that tax bill out, that tax liability, over 20 years. So it might make sense to leave the IRA to a charitable trust and then have it pay out 5% a year for 20 years. And the math does work out on this. So what ends up happening is that, let's say that $3 million IRA goes to a charitable trust, and Sonny could be the beneficiary, or a Dynasty trust for Sonny could be the beneficiary. And that money, that $3 million pays out 5% a year. So it's paying out $150,000 a year. You're spreading out the tax bill so that the $3 million that is held in the charitable trust, the money that would have otherwise been paid in taxes, the $1.5 million, is invested to generate a return. You'll model this out, you do the math. Many times it makes sense, but the numbers really do have to be big enough. But it's a great way, it's a great thing to consider. So that brings us to the end of our time here, our materials. But I do want to close with, is it enough to consult with a lawyer? I would say you need an A-team. And we've talked about this in other webinars. You do need an A-team. I firmly believe certainly if you're a California resident, you need an attorney who is specialized, ideally a certified specialist, or in a firm that has certified specialists, which our firm does, and a CPA and a financial advisor. You really need that. It's like a three-legged stool working together. And estates over $10 million might benefit from a family office. And basically, our family office focuses on keeping track of everything for clients, as well as taking advantage of income tax and other capital gains tax strategies, because sometimes you might be doing something that preclude a really beneficial tax planning strategy. And geez, if I only would have known, then I would have, I wouldn't have been paying those big taxes. So, and then the book Savvy Estate Planning. It's a great primer for estate planning. It's a non-technical book. It's a lot of stories, and we get some really good feedback on it. So if you haven't gotten it yet, I would encourage you to visit our website and order it. And it's right on our website there. We're second edition updated for the Secure Act, and really a great tool, a great primer before you go actually see the lawyer, the book Savvy Estate Planning. We have office locations in Northern and Southern California, and we have our next webinar coming up. June 8th is AB trusts, the good, the bad, and the ugly. Many AB trusts are old ways of doing things and aren't good. Sometimes they are good. So sometimes it's a good thing. Many times it's not. And if you're stuck with one, or maybe you've had a spouse pass away and you have this AB trust, it's a good webinar to attend. If you're married, good webinar to attend. If you have lost a parent and your other parent is living and has a B trust, you might find that there's an embedded capital gains tax in there. So this is really going to be focusing a lot on capital gains tax mitigation, which in California is very high, right? We have a 13.3% income tax rate for capital gains and income. Subscribe to our YouTube channel, and it's really easy. You just click subscribe and click the bell. And we do have, again, our upcoming workshop in the Bay Area, in the Berkeley Marina. And we're going to cover capital gains tax, keeping your Prop 13 tax base, how to hold real estate, and income tax reduction strategies. So you can scan that and register. And we will open it up for questions. And if you're watching this on YouTube, then just keep watching because the next video will roll right up.